Okay, let's unpack this. We're going to skip the usual pile of research papers today and really dive deep into something specific in quantitative trading. Statistical arbitrage pairs trading. It sounds maybe a bit complex, but the core idea, imagine finding two things, like stocks, that usually move together, almost like dance partners.
Yeah, they have a rhythm.
Right. But sometimes one partner kind of steps out of sync for a moment. This whole strategy is about finding those reliable dance partners, spotting when they miss a step, and betting they'll get back in time, and doing it systematically.
Exactly. It's not guesswork. It's based on, well, statistics and data. And our mission here really is to get into the nuts and bolts of it all.
Okay.
We want to understand, how it actually works, why this thing called cointegration is so incredibly important, like foundational, how quants try to model these relationships, the different tools they use, some simpler, some pretty advanced, how the idea goes beyond just two stocks, and maybe the most important part, the real world stuff. The challenges that make the difference between a nice theory and something that actually works or doesn't.
And we've got a good mix of sources to help us figure this out. We're looking at some practical stuff, guides from places like Interactive Brokers, Quant Start.
Those tend to be quite hands-on.
Yeah. And then there's more academic material, reviews you might find, digging around Sci-Hub, even some university stuff like a presentation from HKUs that lays out some core concepts.
So it gives us that blend, right? The theory behind it, but also glimpses of how people actually try to code this up and use it, especially focusing on U.S. stocks like the title implies.
We're not just going to read definitions, hopefully. We want to see how these ideas get put into practice, what the research actually says works, and maybe what doesn't.
Yeah, the limitations are just as important.
For me, the really fascinating part is how systematic it aims to be. It's trying to move away from just looking at a chart and saying, oh, those look like they move together.
Right, no gut feelings here.
It's about finding a relationship that's statistically solid, something long-term like an equilibrium, and then building basically an automated system to trade when prices stray too far from that equilibrium, betting they'll snap back. I mean, how do you even find those connections you can trust not to just drift apart forever?
It's a powerful concept because it tries to bottle a specific market behavior, that tendency for things to revert to an average mean reversion using math and stats you can actually test.
Takes it out of the realm of anecdote.
Exactly, into empirical analysis.
And so let's start right at the beginning. The fundamental idea. How do you profit from mean reversion using pairs trading? What's the basic logic?
Okay, so at its core, it's pretty intuitive, actually. Think of it in two main phases. First phase, the formation period.
Formation period, okay.
This is where you look back at historical data. You're hunting for two securities, maybe two stocks, whose prices have historically tracked each other really closely.
So you're sifting through history, looking for these pairs.
Yeah, looking for assets that seem connected somehow. Maybe they're in the same industry, maybe they're substitutes, maybe it's just a strong historical pattern. You're screening the past.
Okay, phase one, find potential partners based on history.
Yeah.
Then what?
Yeah.
Let's say you found a pair that looks promising.
Then you move into phase two, the trading period. Now you watch them constantly. You monitor the relationship between these two chosen stocks. And the key thing you're tracking is the spread.
The spread, what is that exactly? Just the price difference?
Often, yeah. Or some normalized version of the difference between their prices. If this spread widens out beyond a certain point, meaning one stock has gotten too expensive relative to the other, based on their historical link, that's your signal.
The signal to trade.
A signal to trade. You take positions that offset each other. You short the one that's gone up too much, the outperformer.
Sell it, expecting it to fall back.
Right. And you buy the one that's lagged behind, the underperformer.
Expecting it to catch up.
Exactly. The whole bet, the core assumption, is that this divergence, this widening of the spread, it's temporary. You're betting that the spread will shrink back towards its historical average, its mean.
Mean reversion.
That's the name of the game. And when the spread does narrow back down, you close out both positions, and hopefully you've captured the profit from that convergence.
So it's like there's an invisible rubber band between them, based on history. When it stretches too far, you bet it'll snap back, and you profit from that snapback.
That's a great analogy. You're exploiting what you believe is a temporary mispricing relative to their historical relationship. You're banking on that statistical tendency to return to the average.
Okay. And you mentioned this isn't just about two stocks necessarily. The sources talk about a bigger picture.
Yeah, that's where the term statistical arbitrage or state arb comes in. Simple pairs trading, like just stock A versus stock B, that's really the most basic form of state arb. But state arb is a wider term. It takes that same core principle, find a statistically sound mean-reverting relationship, and trade the temporary deviations, and applies it to more complex situations.
Like what kind of complexity?
Well, you could have what some sources call quasi-multivariate strategies. Maybe you trade one single stock against a whole basket, a weighted portfolio of its competitors.
Okay. So instead of Coke versus Pepsi, it might be Coke versus a little index of Pepsi, Dr. Pepper, maybe some others.
Exactly. You construct your own little benchmark portfolio to trade against, or you can go fully multivariate. You might be looking for relationships and trading divergences within whole groups of assets against other groups.
So groups versus groups.
Right. You might see terms like quasi-multivariate pairs trading or generalized pairs trading in the sources. But underneath it all, it's still about finding some linear combination of assets, a weighted mix whose value you expect to revert to its mean.
So the principle stays the same bet on things returning to average, but you can apply it to two assets, or one versus many, or many versus many.
Got it. Now let's tackle something that seems really, really critical based on the sources. This distinction between simple correlation and this concept of cointegration. Why is cointegration the star here?
Okay, yeah, this is probably the single most important theoretical point to really nail down if you want these strategies to have a chance long term. Most people know correlation.
Right, like things move together.
Yeah, correlation typically measures how the returns of two things move together over some period. If stock A's return is up 1% today, and stock B's return is also up around 1%, and that happens often, they have high positive correlation.
Seems perfect for pairs trading, right? Find highly correlated stocks, trade when they briefly decouple.
And that's the trap. This is the pitfall the sources warn about. You can easily find two stocks whose returns are highly correlated because they're both just riding a big market wave upwards, or their whole sector is booming.
So, day to day, their returns look similar. But if their underlying paths, their actual price levels, are even slightly different, maybe one's growing fundamentally just a tiny bit faster, the gap between their prices can just keep getting wider and wider and wider over the long haul. They never actually come back together. The sources call this spurious correlation.
Spurious correlation. Okay, so they look linked because they're both walking in the same direction in a crowd.
Exactly. Like our earlier analogy. They might seem close for a bit, but there's nothing actually tying their price levels together over time.
No statistical anchor.
No anchor. So if you build a trading strategy based just on that high correlation and they aren't truly linked long term, that spread you're betting will revert. Well, it might just keep going against you, potentially huge losses. Correlation is about short-term co-movement of returns. It says nothing reliable about a long-term relationship between the price levels.
Okay, that's a huge warning. So how does cointegration fix this? What does it tell us that correlation doesn't?
Cointegration dives deeper. It looks directly at the long-term relationship between the price series themselves, not just the returns. Now, technically speaking, as the sources explain, individual stock prices are usually non-stationary.
Meaning they tend to drift, they trend, they don't just hover around one fixed price level.
Exactly. Their average price level isn't constant over time. Their variance might not be constant either. We say they are integrated of order 1 or I1. They have a unit root, statistically speaking.
Okay, so prices wander.
Right. But here's the magic. If 2 or more of these wandering non-stationary I1 series are cointegrated, it means there's a specific weighted combination of them, like taking one price and subtracting some multiple of the other price that is stationary.
Oh, so you combine these wandering series in just the right way.
And the result, this combination, doesn't wander off. It's integrated of order 0, or I0. It behaves like a variable that fluctuates around a constant mean.
And that specific combination, that's the spread we care about.
That is the golden ticket. For a pair of stocks, Y1 and Y2, if they're cointegrated, we can often write their relationship as something like Y1T equals home plus Y2T plus OINT.
Okay, Y1 price equals some constant mu plus some constant gamma times the Y2 price plus epsilon T.
Right, and that OINT, the epsilon, that's the residual. It represents the spread, the temporary deviation from their long-term equilibrium defined by and the crucial part is, if they are truly cointegrated, this residual series, OINT, is stationary.
So the spread itself doesn't drift off to infinity. It keeps wanting to come back to its average value, which is presumably zero or close to it in this model.
Exactly. If that spread is stationary, it has a constant mean it reverts to. Its fluctuations are statistically bounded. So if it moves significantly away from that mean, there's a statistical force pulling it back over time.
The rubber band is real, statistically speaking.
That's the essence of it. That statistical pullback is the mean reversion you can potentially trade. It's the statistical rope tying those two walkers together in our analogy. They can wander apart a bit, stretch the rope, but the Cointegration ensures they are bound to stay close in the long run.
That makes so much more sense now. Trading correlation is like betting on the walkers in the crowd. Trading Cointegration is betting on the walkers tied by the rope.
Couldn't have said it better myself. Cointegration gives you the statistical evidence for that long-term tether that a mean reversion strategy absolutely needs to be built on. The HKE-US tie slides show this visually. They have examples of correlated series where the spread just drifts away versus other series where the spread looks like it's bouncing around a flat line, indicating Cointegration.
So for you, our listener, understanding this is vital. If you try to build a pairs trading strategy just on high correlation, you're building on shaky ground. You need that foundation of Cointegration to have statistical confidence that the spread is likely to revert, giving you those trading opportunities.
Without Cointegration, you're basically just hoping. With Cointegration, you have a statistical reason to expect mean reversion.
All right, crystal clear. Cointegration is the key property. So the next big question is, how do we actually find these cointegrated pairs among, thousands of U.S. stocks? What are the methods?
The sources lay out a few approaches, kind of showing how thinking has evolved. Historically, maybe a simpler, more intuitive method was used first, called the sum of squared distances, or SSD.
SSD.
Yeah, it was used in some influential early research like that Gitev, Gutzman, and Ruin-Horst paper GGR that the Sci-Hub review mentions.
How did that SSD method work? What were they measuring?
It's pretty straightforward, actually. You take the historical prices of potential pairs, maybe normalize them first so they're on a similar scale, and then over your formation period, you calculate the sum of the square differences between their normalized prices at each point in time.
So you're just looking for the pairs whose price charts looked the most similar, the ones that stayed closest together visually over history.
Essentially, yes. It's based on minimizing that distance, that sum of squared differences. It's a heuristic based on historical price path proximity, easy to grasp, relatively easy to code up.
Okay, that's the distance method. But the more statistically rigorous approach, the one tied directly to that Cointegration property we just hammered home, uses formal tests.
Exactly. That's where you bring in the econometric toolkit. You use statistical tests specifically designed to check if that linear combination, that spread derived from non-stationary price series, is actually stationary. The sources mention names like the Ingle-Granger two-step test or the Johansen test.
Okay, Ingle-Granger. How does that work in practice? I think the Interactive Broker source mentioned using a Python function like statsmodels.tsa.statholes.coint.
Right. So for the Ingle-Granger method applied to a pair, y1, y2, step 1, you run a simple linear regression, usually OLS, of y1 on y2 over your historical data window. This gives you estimates for that intercept and that hedge ratio, the inigo from our equation earlier. Exactly. And importantly, it also gives you the residuals from that regression. That's your estimated spread for each point in time in your history.
Okay, so you've calculated the historical spread based on the best fit line.
Step 2 is the critical test. You take those calculated residuals, that Hunt series, and you perform a stationarity test on them. Usually the augmented Dickey-Fuller test or ADF test.
Ah, so you're not testing the original prices Y1 or Y2 for stationarity we already suspect they aren't. You're testing if the spread, the leftover bit from the regression, is stationary.
Precisely. If the ADF test on those residuals comes back saying they are stationary technically, you reject the null hypothesis that they have a unit root. Then you have statistical evidence that Y1 and Y2 are cointegrated. Boom, you've found a pair with that statistical rope connecting them.
Okay, that's the rigorous test. So how do these two main approaches, the simple SSD distance method and the formal cointegration tests, stack up against each other? Which one works better?
Well, the general view you get from the sources, especially academic review, is that cointegration testing is fundamentally more sound for this particular strategy. SSD finds pairs that happen to track closely in the past based on distance.
But cointegration testing directly verifies the statistical property, the stationarity of the spread, that you actually need for a mean reversion strategy to work reliably.
Exactly. It's testing for the mechanism you want to exploit.
So, theoretically stronger. Does it lead to better results in practice?
There's evidence suggesting it might. The Sci-Hub review mentions studies indicating that pairs identified via cointegration tests can be more profitable. And interestingly, they also tend to exhibit higher volatility in their spreads.
Higher volatility. Isn't volatility usually seen as a risk?
In this context, higher spread volatility can actually be good. It means the spread tends to make bigger swings away from its mean. Bigger swings mean potentially more frequent trading signals and larger price moves to capture when the reversion eventually happens. Ah, okay. So the statistically sound pairs might also offer more opportunities, bigger potential profits per trade, because the rubber band stretches further before snapping back.
That's the idea. Now, people have also tried combining methods. The Sci-Hub review mentions a study by Rad and colleagues where they first used a distance method like SSD to create a short list of candidates and then applied a Cointegration test only to that short list.
Seems logical. Filter quickly, then test rigorously. What's the verdict on that?
The review points out a potential issue. If you pre-filter based only on minimizing historical distance, SSD, you might inadvertently bias your selection. You might just end up picking pairs that look good based on distance, maybe missing pairs that are genuinely cointegrated but didn't happen to have the absolute tightest historical fit visually.
So the initial SSD filter might throw out some ugly ducklings that are actually beautiful swans in terms of cointegration. Potentially, yeah. The review sort of leans towards the idea that an end-to-end cointegration-based selection where the primary filter is passing the cointegration test with statistical significance might be a more robust approach if you really want to find all pairs exhibiting that key property, not just the ones that also happen to look historically closest.
Right. Focus the search using the tool designed to find the exact thing you're looking for, the stationary spread.
It's about aligning the selection method with the underlying principle of the strategy.
Okay, makes perfect sense. So we've used our fancy statistical tests. We found some promising cointegrated pairs. Now what? We need to actually model this relationship in a way we can use for trading and generate signals. How does that work?
Great. So we have our cointegrated pair, y1, y2, and that conceptual relationship, y1t equals I'm plus t2t plus sin. The modeling step is about getting concrete estimates for the interceptor long-term mean offset and do the hedge ratio or slope using historical data.
And the simplest way to get those estimates?
The workhorse method, mentioned frequently, is just ordinary least squares regression, OLS. You take a chunk of recent historical data for your pair, say the last year of daily prices, and you run a linear regression of y1 onto y2.
Like fitting a straight line through a scatter plot of their prices.
Exactly. OLS finds the constant values for S that minimize the squared errors between the actual y1 prices and the prices predicted by the line plus GAOT over that historical window.
Okay, so OLS gives you a single static number for the hedge ratio, gamma, and the intercept, based on that look-back period.
Correct. It provides static estimates. You then use these owns and values during your trading period to calculate the current spread, ONO TRIOA NT plus GOOT. The HKUS presentation has some really nice plots showing this. They show a pair, EWH versus EWZ, I think it was, where the spread calculated using OLS looks pretty stable, bouncing around 0. They call it a good case.
Okay, let's mean reverting.
But then they show another pair, EWY versus EWT, where even after calculating the spread using OLS, that spread still seems to drift significantly over time. It highlights that OLS just estimates the relationship based on history. It doesn't guarantee the underlying cointegration property holds perfectly going forward. The spread still needs to be fundamentally stationary.
Right. OLS gives you a spread calculation, but the pair still needs to be truly cointegrated for that calculated spread to actually mean revert reliably. What's the big drawback of relying purely on this static OLS estimation?
The main weakness, hinted at by that drifting spread example, is the core assumption that OLS are constant over time. Financial markets aren't static. Relationships between assets evolve due to changing fundamentals, market conditions, all sorts of things.
So the true rope connecting them might be stretching or shrinking a bit over time.
Exactly. And a static OCA estimated from last year's data might not be the right hedge ratio for trading today.
So if the relationship itself is changing, OLS won't keep up. Is there a method that can handle evolving relationships?
Yes, and this is where things get more advanced and, frankly, quite interesting. The Kalman filter is brought up in both the QuantStart and HKUS sources as a powerful adaptive alternative.
Kalman filter. I've heard of that. Isn't it used in things like navigation and tracking?
That's exactly where it came from. Tracking moving objects like missiles or airplanes where you have noisy measurements like radar pings, and you need to estimate the object's true state, position, velocity, even as that state is constantly changing.
Okay, tracking missiles to tracking stock prices. Seems like a bit of a jump.
But the core problem is similar. Instead of assuming a fixed relationship y and t equals 1 plus guido t plus sint, the Kalman filter approach models it as time-varying. Y conco t will I con t plus sio t plus ut. It treats the parameters or dot themselves as a hidden state that evolves over time.
So the hedge ratio and the mean of the spread are not fixed numbers anymore. They're variables the filter is trying to estimate moment by moment.
Precisely. The Kalman filter works recursively. At each new time step, like each new minute of price data, it first predicts where it thinks the hidden state will be. And based on that, it predicts what the next observation, the price of Y1, should be, given the current price of Y2.
Okay, it makes a guess.
Then, the actual price of Y1 comes in. The filter compares the actual price to its prediction. The difference is called the forecast error, or innervation. It then uses this error to update its estimate of the hidden state. It learns from its mistake, essentially.
So it's constantly predicting, checking against reality, and adjusting its understanding of the relationship parameters based on the new data.
That's the beauty of it. It provides you with estimates of art and jut that adapt over time. The HKU visuals comparing the spread from a static OLS model versus the forecast errors from a Kalman filter are quite telling. Often, the Kalman filter's error term looks much more stationary, more cleanly mean-reverting around 0, precisely because the filter is adjusting the art and jut to account for drifts in the underlying relationship. The QuantStart article's P&L chart for a TLT-IEI pair traded with a Kalman filter also suggests potential benefits.
That sounds like a major advantage, especially if you believe market relationships aren't perfectly stable. Okay, so we have ways to model the relationship and estimate the spread, OLS, or the forecast error, Kalman. How do we turn that into actual buy and sell signals?
Once you have your spread series or error series, you need rules. The most common approach, clearly shown in the Interactive Brokers example code, involves using Z-scores for the OLS spread.
Standardizing the spread.
Yep. You calculate the spread. Then you calculate the mean and standard deviation of that spread over some recent look-back window. The Z-score is just spread mean, standard deviation.
Tells you how many standard deviations the current spread is away from its recent average.
Exactly. Then you set thresholds. For example, maybe you set an entry threshold at plus 1.5 standard deviations and minus 1.5 standard deviations.
So if the Z-score climbs above plus 1.5, that means Y1 is significantly overpriced relative to Y2 based on the recent history.
Right. That's your signal to short the pair. Short Y1, long Y2, betting the Z-score will come back down towards 0. Conversely, if the Z-score drops below minus 1.5, you long the pair. Long Y1, short Y2.
Like getting out of the trade.
You usually set exit thresholds closer to the mean, maybe at plus 0.5 and negative 0.5, or even just 0. When the Z-score crosses back over that exit threshold, heading back towards the average, you close both legs of the trade, hopefully capturing the profit from the reversion. The IB source explicitly mentions parameters like entry threshold and exit threshold.
Okay, standard deviation bands around the spread. How does the Kalman filter generate signals? Is it still using a Z-score of something?
With the Kalman filter, the signal generation is often tied more directly to that forecast error we talked about. The QuantStart example for the TLT-IEI pair illustrates this well. Instead of calculating a Z-score of spread based on a static relationship, it looks at the Kalman filter's one step ahead forecast error, let's call it ET.
The difference between the filter's prediction and the actual price.
Right, and it compares that error ET to the filter's own estimate of the error's standard deviation, which QuantStart calls Squart QT. The trading logic in their code is something like, if ET dash Squart QT, meaning the actual price was significantly lower than the filter predicted, suggesting Y1 is cheap relative to Y2 given the currently estimated dynamic relationship, then enter a long position in the pair.
And the opposite for short.
Yep. If at Squart 2 key, actual price significantly higher than predicted, enter a short position. The exit is often triggered when the forecast error ET crosses back through 0, indicating the mispricing relative to the dynamic model has corrected itself.
That feels more immediate. It's reacting to deviations from the current best estimate of the relationship, not deviations from some older average of a potentially outdated static relationship.
That's the potential advantage, yes. It aims to be more responsive.
Now, a really practical question. When you get a signal, How do you know how much of stock Y1 to buy and how much of stock Y2 to short? That hedge ratio must be key here.
Absolutely critical. The hedge ratio dictates the relative position sizes. Its purpose is to make your combined position roughly neutral to the overall market movements or sector trends that affect both stocks. You want to isolate your exposure purely to the mean reversion of the spread itself, not just ride the general market up or down.
So if EC is, say, 0.6, does that mean for every $1,000 of Y1 you buy, you need to short $600 of Y2?
Essentially, yes, in dollar terms, or based on the number of shares derived from that ratio. If you're long one share of Y1, you'd short aux shares of Y2 to achieve that theoretical hedge. The exact sizing might involve other factors like volatility scaling or risk capital allocation, but the ratio of the positions comes from GOP.
And is that static, or does it change?
Well, with the standard OLS approach, you typically estimate GOK once during the formation period and use that static GOK throughout the trading period.
So a fixed hedge ratio.
Right, but with the Kalman filter, because it's producing a time-varying estimate of the slope, GOK, your hedge ratio can and probably should adapt over time. The Quant start code snippet actually shows their Kerhedgety variable is updated based on self-dukkha, which represents the Kalman filter's current estimate of that slope parameter.
Okay. So the Kalman filter not only potentially improves the entry exit signals by tracking the changing relationship, but it also tells you how to adjust your relative position sizes dynamically to try and maintain that hedge as the relationship evolves.
That's the goal. It's trying to build a more adaptive, robust strategy in the face of non-stationary market dynamics.
Okay, this is getting really interesting. We've covered the theory, the modeling, the signals. Let's talk implementation. Section 5 gets into the code, the deep quant stuff. What does someone actually need to build and test one of these things?
Right, you need the toolbox. First off, a programming language. And let's be honest, in quant finance today, Python is pretty much the king.
Why Python?
Mostly because of its incredible ecosystem of libraries. You've got libraries for pretty much everything you need. For handling data reading price files, manipulating time series pandas is absolutely essential. It gives you things like data frames, which are perfect for this kind of work.
Okay, pandas for data wrangling. What about the stats we talk about? Cointegration tests.
For that, the stats models library is your go-to. It has implementations of Engle-Granger, Johansson tests, ADF tests, all the econometric tools we discussed. If you're doing the simpler OLS regression modeling, scikit-learn is fantastic and widely used for machine learning and linear models in general.
And seeing the results. Plots.
Matplotlib is the standard for plotting P&L curves, visualizing the spread over time, checking if it looks stationary, all that good stuff.
So the usual data science stack plus some specialized finance stats libraries. What else? You can't just run this in a notebook and expect it to work like real trading, right?
Absolutely not. To see how your strategy might have actually performed historically, you need a proper backtesting framework. QuantStart uses QStrader in their example. There are others like Zipline, Backtrader, or platforms like QuantConnect.
What does a backtesting framework actually do?
It simulates the entire trading process over historical data, trying to be as realistic as possible. It feeds you the price data, bar by bar, like minute by minute. Your strategy code receives that data and decides if it wants to generate a trade signal. If it does, the framework simulates sending an order, potentially modeling execution delays and costs. It keeps track of your hypothetical portfolio, how much cash you have, what positions you hold. It calculates your P&L along the way.
It sounds like it needs different modules working together.
Yeah, typically they have a structure like the one hinted at in the QStrader example. You'll have something like a price handler that serves up the historical data. The strategy object contains your core logic, analyzing the data, deciding when to signal a trade based on Cointegration, OLS, or Kalman filter rules.
Okay.
Then a position sizer might take that signal and decide how much to trade using the hedge ratio and maybe considering risk limits. A risk manager could enforce rules like maximum drawdown or position limits. An execution handler tries to simulate how the order would actually get filled, importantly, accounting for potential slippage based on bid-ask spreads or market impact. And finally, a portfolio handler maintains the state of your account positions cash equity curve.
That makes sense. It's like building a mini simulation of a trading desk.
Yeah.
Now, data. You mentioned data quality. How critical is that, and what kind do you need?
Data is everything. Garbage in, garbage out absolutely applies here. You need clean, accurate historical price data, but frequency depends on your strategy. The Interactive Brokers source mentions using 1-minute OHLCV, open, high, low, close volume data from DataBento, which is suitable for strategies that might trade intraday.
And for slower strategies.
Daily data, like the Yahoo Finance data used in the QuantStart example, might be enough if you're only planning to trade, say, once a day or less frequently.
Is there even more detailed data that helps?
Yes, especially for accurately modeling those crucial transaction costs. The IB source mentions MBP1 data market by price, level 1. That gives you the best bid price and size and the best ask price and size at any given moment.
Why is that useful?
Because it tells you the bid-ask spread. If you want to buy, you'll likely pay the ask price. If you want to sell, you'll likely get the bid price. Knowing that spread allows you to make a much more realistic estimate of your slippage costs in your backtest, rather than just assuming you can trade at the midpoint. But beyond the detail level, there's a massive potential pitfall with historical data that sources like Quant Connect highlight: survivorship bias.
Survivorship bias. Explain that.
Okay, imagine you download historical data for all stocks currently listed on the NYSE. That dataset only includes the survivors. It's missing all the companies that used to be listed but got delisted over the years. Maybe they went bankrupt, got acquired, failed to meet listing standards.
So it excludes the failures.
Exactly. And those failures often performed poorly before they disappeared. If you backtest your pairs trading strategy only on the stocks that survived until today, your results are likely to look way better than they would have in reality, because you've conveniently ignored all the pairs where one or both components might have gone bust or performed terribly.
Ah, I see. You're testing on a pre-selected group of historical winners, which inflates your perceived performance.
Precisely. For a truly realistic backtest, especially over long periods or involving many stocks, you need historical data that includes these delisted securities. Survivorship bias-free data is essential to get an honest assessment of how your strategy might have fared through thick and thin, including pairs that failed.
That's a sneaky one. Easy to miss if you're not careful. Okay, so you've got your framework, your clean survivorship bias-free data. You run the backtest simulation. How do you judge if it was any good?
The backtester spits out performance metrics. The most basic is profit and loss, P&L. You'll see gross P&L, the profit before any costs are deducted.
Looks good on paper.
Often does. But then you must subtract estimated transaction costs, commissions, exchange fees, and especially that estimated slippage we talked about to get your net P&L. That's the number that matters more. The IB source shows calculating both.
So net P&L of the acid test after frictions. What else?
You don't just look at total profit. You need to consider the risk taken to achieve it. The standard metric here is the Sharpe ratio. It measures your excess return, how much you made above a risk-free investment like T-bills, divided by the volatility, standard deviation of those returns.
So return per unit of risk.
Yeah.
Higher is better.
Generally, yes. A higher Sharpe ratio suggests you're getting more bang for your buck, risk-wise. The IB example backtest output includes a Sharpe ratio calculation.
Makes sense. But backtesting. It's still just a simulation, right? It's not real trading.
Crucially, yes. It's a vital step for developing and refining ideas, for seeing if something has potential before risking capital. But it has major limitations, which tie directly into the risks we need to talk about later. It's an estimate, not a guarantee.
Okay, so we've got pairs, modeling, implementation frameworks, data, backtesting. Let's scale up now. Section 6 mentions moving beyond simple pairs to broader statistical arbitrage using multiple assets. How does that work conceptually?
Right. This is about taking that core mean reversion idea and applying it to larger groups. Instead of just looking for A versus B, you might look at a whole sector, say U.S. bank stocks, and ask, is there some stable mean reverting relationship among a group of these banks?
So finding a relationship within a portfolio of, say, 5, 10, 20 stocks. That sounds much more complex mathematically.
It is. It requires multivariate time series tools. The main technique highlighted in the HKUS source is the Vector Error Correction Model, or VECM.
VECM, what does that do?
VECM is specifically designed to analyze a system of multiple non-stationary time series all interacting with each other. And its key feature for us is that it can identify if there are cointegration relationships within that group.
So like Ingle Granger finds cointegration between two series, VECM can find it among many.
That's the idea. If a group of stocks is cointegrated, VECM can estimate the cointegration vectors. There might be more than one. Each vector is essentially a set of weights.
Weights for what?
Weights to apply to the prices of the stocks in the group. If you create a portfolio using those specific weights, say long SUBU dollars of stock 1, short dollars of stock 2, long zebra to stock 3, etc., based on the Cointegration vector, the total value of that weighted portfolio is expected to be stationary.
Ah, a mean-reverting portfolio, an MRP. So instead of the simple spread Y1 Guy2 being stationary, VECM finds a weighted combination of many stocks.
Right.
Let's say WTYT, where W is the weight vector and yet OBLT is the vector of prices. That is stationary.
Exactly. The VECM analysis mathematically derives the specific weights W needed to construct this portfolio, whose value should theoretically fluctuate around a constant mean.
Okay, I think I get it. VECM is like a sophisticated tool that tells you exactly how to mix a basket of ingredients, stocks. So the resulting mixture, the portfolio value, has this desirable mean-reverting property.
That's a good way to put it. And once you've identified this mean-reverting portfolio and its weights, you trade it just like a pair. You monitor the portfolio's value over time. If it deviates significantly from its historical mean,
To trade the whole basket.
yes, you simultaneously buy or sell all component stocks according to the weights given by the Cointegration vector, betting that the portfolio's total value will revert to its mean.
And the HKUST materials suggest that these multivariate approaches might even be better than simple pairs sometimes.
They hinted at that, yeah, suggesting that the spreads derived from these VCM cointegration vectors could potentially offer higher returns or better risk-adjusted returns, Sharpe ratios, compared to trading simple two-asset spreads.
Why might that be?
Perhaps because you're capturing a more complex, maybe more fundamental economic relationship across a whole group of related companies. Or maybe it provides better diversification against the idiosyncratic risks of just relying on a single pair blowing up.
Interesting. So VECM lets you go from finding dance partners to finding whole choreographed troops that tend to stick together. A more powerful generalization.
Potentially, yes. It opens the door to finding more subtle, possibly more robust, mean-reverting opportunities hidden within larger baskets of assets.
Okay, this all sounds incredibly logical, statistically grounded, almost elegant on paper. We've got the math, the potential for sophisticated modeling, the code frameworks. But now, Section 7, the reality check. Market frictions and risk. This is where the rubber meets the road, Robbie.
Yeah, absolutely. This is make or break time. Ignoring these practicalities is how people lose money, even with strategies that looked amazing in backtests. The number one killer, transaction costs.
And that's more than just the broker commission, right?
Oh, much more. Commissions and fees are usually the smallest part, especially with modern brokers. The real friction, particularly for strategies that might trade somewhat frequently or rely on capturing small price discrepancies, is slippage.
Slippage. That's the difference between the price you saw on the screen and the price you actually got filled at.
Exactly. You see the midpoint price, you send your order, but by the time it executes, the market has moved slightly, or more likely, you had to cross the bid-ask spread to get filled. If you buy, you hit the ask, higher price. If you sell, you hit the bid, lower price. That spread is a cost.
And the wider the spread, or the bigger your order,
the more slippage you're likely to face. Using that level 1 MBP1 data with bid-ask prices helps estimate this in backtesting, but it's a very real drag on performance in live trading.
And the sources seem pretty blunt about how damaging these costs can be.
Extremely blunt. The SIOP review pulls together findings from several studies. People like Duan Pfaff, Bowen et al. They showed that once you factor in realistic transaction costs, especially slippage, the apparent profitability of many pairs trading strategies just vanished, or worse.
Wow.
Bowen et al.'s study on high-frequency FTSE pairs was particularly striking. They found that adding transaction costs plus just a 60-minute delay between signal and execution completely wiped out any theoretical profits.
A 1-hour delay killed it. That really drives home how sensitive some of these strategies can be to timely execution and costs. They're often trying to capture tiny, fleeting edges.
Precisely. Any delay, whether it's network latency, exchange processing time, your own system's lag, can mean the price moves against you before your order gets filled. What looked like a profitable entry becomes a loss. For tighter spreads or higher frequency trading, execution quality is absolutely paramount.
And what about the shorting leg? Is that always easy?
Another practical headache. For big, liquid U.S. stocks, borrowing shares to short is usually straightforward and cheap. But if your strategy involves smaller, less liquid stocks, you might run into high borrowing fees, paying interest to borrow the shares. Or worse, the stock could become hard to borrow, meaning you might not be able to initiate a short, or you could even be forced to close your short position prematurely, a buy-in. The GGR study suggested it wasn't a huge issue for their large cap focus, but it's definitely a constraint to consider.
Okay, so costs and execution friction are huge. What about just the fundamental risk of being wrong, the strategy not working? The Sharpwick source had some stark warnings.
And those warnings need to be taken extremely seriously. Pairs trading, these are not risk-free endeavors. The sources are clear. These strategies involve substantial risk. You can lose more than your initial investment.
Especially with leverage.
Absolutely. Because the expected profit per trade might be small, quants often use leverage to magnify returns. But leverage cuts both ways. It also magnifies losses dramatically if the trade goes against you and the spread keeps widening instead of reverting.
So definitely not guaranteed money.
Not even close. It requires sophisticated risk management. The disclosures emphasize using only risk capital money you can afford to lose entirely without jeopardizing your financial well-being.
And those compelling backtest results we talked about building, they come with massive caveats.
Huge caveats. That hypothetical performance disclosure isn't just boilerplate. Backtests have fundamental limitations because they are not real trading.
What are the key differences?
Well, first, there's no real money at stake. So the psychological pressure, the fear and greed that affects real trading decisions is completely absent. It's easy to follow rules in a simulation, much harder when your account balance is dropping.
The emotional factor.
Huge.
Massive. Also, backtests often make simplifying assumptions. They might assume you get filled instantly at the exact price you wanted, no slippage, or that there's always enough liquidity to trade your desired size without moving the market. They assume market conditions during the backtest period will resemble the future.
But reality is messy.
Reality is very messy. Liquidity can vanish in seconds, markets can enter new regimes, execution is imperfect. Backtests can look great because they smooth over or ignore these real-world problems. That's why past performance, even real past performance, let alone hypothetical, is never a guarantee of future results.
So backtesting is essential for development, but you absolutely cannot take the results at face value for predicting future profits. It's step one. The leap to live trading introduces all these frictions and risks that are incredibly difficult to model perfectly and even harder to navigate psychologically. And if you're running not just one pair but a whole portfolio of these strategies, risk management becomes about monitoring overall exposure, correlations between your pairs, potential drawdowns. It's a complex task.
Okay, that's a vital dose of realism. We've gone through the mechanics, the models, the code, and the harsh realities. Let's wrap up by looking forward. Section 8 touches on where this field might be heading. What are the frontiers for pairs trading and spade arb?
Yeah, the sources suggest it's an active area. Researchers and quants are constantly trying to refine things, especially to deal with those market dynamics and frictions we just discussed. One key theme seems to be combining the best of different approaches.
Like mixing the rigorous selection with the adaptive trading.
Exactly. For example, use robust statistical methods like cointegration testing, or VECM, to find fundamentally sound pairs or portfolios. That gives you the theoretical basis. But then, instead of using simple static Zscore thresholds to trade them, maybe use more dynamic trading rules.
Rules that adapt.
Yeah, rules that adjust based on current market volatility, or maybe use signals derived from something more adaptive like the Kalman filter's forecast error, rather than just deviation from a static mean.
Yeah.
The idea is to be smarter about when and how you enter and exit, even after finding a good cointegrated relationship.
So finding the relationship is step one, but optimize the trading of that relationship is step two, and maybe just as important.
It could be. The Sci-Hub review mentions studies looking into dynamic rules for trading multivariate portfolios, like those from VECM, and seeing some promising signs. But, and this is a recurring theme, they also stress the need for more large-scale empirical tests to really confirm these things work consistently across different markets and times.
Right. Validation is key. You need to make sure it's not just finding patterns in one specific historical data set.
Absolutely. As the methods get fancier, the risk of overfitting finding complex patterns that worked purely by chance in the past but won't repeat gets higher. So rigorous out-of-sample testing, using that survivorship bias-free data, becomes even more critical.
And the final piece of the puzzle.
Yeah.
The market itself fights back, right? Efficiency.
The age-old problem for quants. As more people figure out and trade a specific inefficiency, like a particular type of mean-reverting pair, their trading activity tends to push prices back towards equilibrium faster.
They arbitrage the opportunity away.
Exactly. The deviations might get smaller, the reversions quicker, the relationships themselves might break down more often. The edge shrinks. It means you constantly need to research, adapt, refine your methods, or look for new, less crowded sources of potential mean reversion.
It's a never-ending arms race, in a way.
It kind of is. Staying ahead requires continuous innovation.
Okay, wow. What a deep dive that was. We started with the basic concept of two stocks dancing together, went through Cointegration as the statistical glue, explored OLS and Kalman filters for modeling, touched on coding and backtesting, scaled up to multivariate state arb with VECM, and then hit the wall of real-world costs and risks.
Yeah, a quick recap. The core idea is exploiting mean reversion. Cointegration is the essential statistical property you need for that long-term tether, much more reliable than just correlation.
We saw methods to find pairs range from simple distance, SSD, to rigorous tests like Ingle-Granger, checking for that stationary spread.
Modeling can be static, OLS, or adaptive, Kalman filter, with Kalman offering time-varying parameters and signals potentially based on forecast errors.
The idea extends to multiple assets using things like VECM to find mean-reverting portfolios.
But the reality check is harsh. Transaction costs, especially slippage, and execution delays can kill profitability. And the risks our substantial backtests are hypothetical, use only risk capital.
So for you, listening in, hopefully this gave you a really solid look under the hood of these quantitative strategies. It's a blend of stats, coding, and dealing with messy reality. It's complex, no doubt, but that core logic finding and systematically trading mean reversion is a really powerful idea in finance.
It's that constant search for repeatable patterns, for signal in the market noise, and building systems to try and capture it.
So let's leave you with a final question to chew on. Markets change, relationships evolve, edges shrink. With powerful adaptive tools like the Kalman filter now available, how can traders continuously find, model, and profitably trade these shifting cointegrated relationships in ever more efficient markets? What new data sources, maybe alternative data or new signal processing techniques or different ways of looking at multivariate relationships might uncover the next set of reliable mean reverting patterns that others haven't found yet? Or maybe just allow you to track the known ones better as they subtly change.
The search for alpha never really ends.
Thank you so much for joining us on this deep dive.
My pleasure. Fascinating topic.